But it gives me enormous pleasure to welcome our second keynote of the morning. So Sir Dave Ramsden is the Deputy Governor for Markets and Banking at the Bank of England. Could not be more timely, Sir Dave, for your keynote today. So enormous thanks from conference and a very warm welcome to the stage.
Thank you, Minette, for that introduction, and it's a huge honour to be here today speaking at the NFU Conference, and a particular pleasure to be here in Birmingham and speaking to you all face to face on behalf of the Bank of England. I know how pleased my late mother would be too. She was born on a mid-Wales hill farm and throughout her life maintained a strong link to her roots. Now, these are challenging times for the economy and for the farming industry in particular. The issues you're discussing at conference, uncertainty, cost pressures, food security and sustainability are crucial ones for the UK's economic resilience and its future prospects. Now, I recognise that starting your day with a speech on monetary policy may be a bit of a departure from more usual NFU conference topics. But given the outlook for costs and inflation and the very real challenges these will be posing for you, I hope you will find it useful. What I want to use my time here today to do is to set out how the Bank of England Monetary Policy Committee is thinking about the outlook for the economy in the face of the shocks which are impacting it, including my own perspectives as one of the 9 voting members of the MPC, and to explain what actions we are taking in response. But I want to start by recognising some of the key challenges facing NFU members today. The MPC sets monetary policy for the economy as a whole, but to be able to do that, we need to understand in detail what is happening across all sectors of the economy and in all regions and nations of the UK. That includes farming, both as an important sector in its own right and as a key link in the broader agri-food supply chain. Agriculture contributes almost £10 billion of the UK's total production, or GDP, and the wider agri-food sector, £127 billion, or 6.5% of national income or production. But numbers don't do justice to the wider significance and role of our farming sector, not just for the economy, but for wider society and the environment. Nor do they bring out the diversity of subsectors and business models that make up the farming industry. Now, one way we at the bank build our understanding is through our UK-wide network of local agents. Our agents engage with hundreds of businesses and organisations right across the economy, including the NFU and its members, to gather intelligence and insight into what is actually happening on the ground. The intelligence they gather is incredibly valuable in helping policymakers like me understand the detail behind the economic statistics. I personally find it a really useful source of evidence when making my own policy decisions. And alongside participating in your conference today, I'll be speaking with a number of local businesses to hear their take on the latest developments. The themes coming through from our agents' intelligence from the farming sector and from my own discussions with people in the industry and related sectors will no doubt be familiar ones to many of you today. Some are structural, perennial issues, while others are more specific to the current situation. The main theme is the immediate cost challenges facing the sector. The price of raw materials and key inputs has risen sharply over the past year. As Minette highlighted, we hear, for instance, of aggregate fertilisers prices having more than doubled and individual prices having gone up further still, and of feed prices doubling. Energy and fuel prices, especially gas prices, have also risen even more sharply in recent months. And while output prices may have risen as well, that isn't always enough to cover cost increases in a sustainable way. The tight labour market also poses challenges, with labour shortages and rising wages in the wider economy all making recruitment difficult and putting upward pressure on agricultural labour costs. A second theme we hear is one of disruption, not just from storms Dudley, Eunice and Franklin, but from the adjustments required to a wide range of shocks hitting the economy. Although the Omicron wave does thankfully appear to have passed its peak, COVID rates remain high and that continues to disrupt production and demand. The continuing adjustment to post-Brexit trading arrangements is also posing challenges for some businesses, while over the longer term, the opportunities from new trade deals and the move to a new environmental land management scheme will be a key factor shaping farming business models. Disruption to global trade is also having an impact, with global supply bottlenecks leading to delivery delays and shortages of key inputs and capital goods such as machinery. A third theme from our engagement with the sector is a clear and open-minded focus on the future, as exemplified by the blueprint for the future theme of your conference. We hear about a farming sector keen to adopt new technologies to invest in that future, whether that is electrifying heavy machinery or applying the latest artificial intelligence and data analysis techniques. And we hear about a sector eager to provide responsible stewardship for our landscape and for the environment, and to play its part in responding to climate change and supporting the transition to a net zero economy. I know the last of these in particular is something that has been a priority for the NFU for some time. And while it isn't the main subject of my speech today, I do want to emphasise that climate change is also a priority for the Bank of England. I will just highlight two of our climate change work programmes in particular. The first is our ongoing work to ensure that banks and financial firms identify and address climate-related financial risks, including scenario analysis to help them understand the risks to their own balance sheets. And the second is our work to green the £20 billion portfolio of corporate bonds that we currently hold for monetary policy purposes. We're adjusting our investment approach so as to incentivise the companies whose debt we hold and the wider investment community responsible for managing trillions of pounds that Minette referred to change their behaviours in meaningful and lasting ways to the benefit of the economy as it transitions to net zero. Now, the economic challenges facing the farming sector and the wider UK economy are many and varied, but many of them share a common economic cause. What we're seeing is the impact of an economic expansion coming up against the ongoing effects of three major economic shocks from the past 5 years: Brexit, COVID, and now the energy shock. A key question for the economic outlook is whether the economy can prove resilient to the risks posed by these three very significant shocks. What do I mean by economic resilience? Now, I gave a speech in Inverness 3 years ago where I defined it as the ability of an economy to withstand and recover from shocks. In other words, unexpected economic difficulties. It's a hard concept to capture in a single number, though a lot of my focus today will be on two numbers: GDP, a measure of the UK's national production or income, and on inflation. And indeed, I would say that focusing on narrow measures of resilience was one reason we missed the broader economic vulnerabilities that were revealed in the global financial crisis. Now, the role of the Bank of England in supporting the UK's economic resilience is clearly laid out in our mission, quotes, to promote the good of the people of the United Kingdom by maintaining monetary and financial stability. Now, the Bank's Monetary Policy Committee works to maintain monetary stability by keeping price inflation low and stable, close to its target rate of 2% per year, while minimising undesirable volatility in output. And the Bank's Financial Policy Committee, the FPC, works to maintain financial stability by making sure the financial system has the capacity to continue providing financial services to the wider economy in bad times as well as good. Now, I'm speaking primarily about the monetary stability side of our work today, but the financial stability side is just as important. It's the work of the FPC that means that the events that we saw in the global financial crisis didn't repeat themselves in the face of the COVID shock, and that the very serious health and economic crisis we faced was not accompanied by another financial one of the sort we saw from 2007 to 2009. The three major shocks that I mentioned, Brexit, the coronavirus pandemic, and energy, are all very different. Each has had a different cause, has affected the economy in different ways and on different timescales, and has required very different responses from policy makers. COVID has had by far the largest impact on GDP, and it would be even larger were it not for the fiscal, monetary and financial response of much of the last 2 years. The impact of Brexit has been less immediately obvious, as the economic adjustment to that is a slower and ongoing process. The impact of the energy shock, meanwhile, has so far at least mainly been seen in the upward pressure it has put on consumer prices since the start of 2021. Both Brexit and COVID have also been significant sources of uncertainty for businesses, as they tell us in their responses to our Decision Maker Panel survey. Uncertainty is particularly relevant as a key driver of business investment, which accounts for roughly 1/10 of GDP and has been particularly hard hit by the succession of shocks I've described. At the end of 2021, business investment was still over 10% below its level before the pandemic struck. And the energy shock is one of the newest sources of uncertainty that firms and individuals, as well as we on the MPC, are currently grappling with. Against that backdrop, it seems hardly surprising that today's first panel session for your conference asks whether uncertainty is the new normal for business. The shock of the coronavirus pandemic has been with us for 2 years now. In that time, we've seen multiple waves of COVID infections, most recently the Omicron variant. Case rates in the UK have fallen from their peak at the turn of the year, and most measures to contain the virus have now been lifted. So although Omicron depressed GDP somewhat in December and January, its direct economic impact is now likely to be limited and of short duration, with output likely to return its pre-pandemic level, though not its pre-pandemic trend, once again by the end of the first quarter of 2022. The wider economic impacts of the COVID pandemic, however, are very much still with us. Bottlenecks have re-emerged in global markets through the course of 2021 as economies have recovered. Global consumer spending, especially in the US, has rotated away from services and towards goods. That's put additional pressure on global supply chains, which had already been disrupted by COVID, which in turn has led to sharp increases in input and transport costs, as well as backlogs and shortages in production. These global trends are one of the key drivers of the economic challenges affecting the farming sector that I mentioned earlier. Although it's still early days, global supply chains do appear to be demonstrating some resilience to this shock. Demand is starting to rotate back towards services. Supply chains are beginning to adapt, and shipping costs appear to be flattening off or falling. Full adjustment is likely to take some time, and the ongoing Omicron waves in some countries could delay that process further. But the MPC's overall judgment is that global bottlenecks should fade over the next 12 months or so. Other consequences of the COVID shock, however, seem likely to be with us for somewhat longer. There are now over 500,000 fewer people in the UK classed as participating in the labour market than there were before the pandemic. Most of that increase reflects people leaving the market due to sickness or study, some of whom will no doubt return over time. Given that the COVID shock came soon after the UK left the EU on 31st of January 2020, and during the transition period, it's impossible to separate out the effects of COVID from the ongoing effects of leaving the EU. The effects of Brexit are expected to build over time and lead to some persistent negative impacts on the level of potential GDP through their impacts on openness and trade, what economists call scarring. Economic scarring means lower incomes and GDP and a reduction in the amount of demand that can be accommodated without generating inflation. Participation aside, however, the scarring effects of COVID appear likely to be smaller than we might have feared. partly as a result of the very substantial economic policy measures that were put in place, in particular the government's furlough scheme, employment has remained resilient, with unemployment falling to 4.1% in the latest data, only slightly higher than its level prior to the pandemic in 2019 Q4. At the same time, the successful adoption for many of working from home technologies could, if anything, contribute positively to productivity. We set out our latest analysis on this in our November monetary policy report. Reflecting all this, the MPC's estimate for the long-run scarring effect of COVID is now around 1% on GDP, about a third of the size of the equivalent estimate for the long-run effects of Brexit. One question that remains to be answered, however, is whether the combined Brexit and COVID shocks have had a more fundamental impact on the flexibility or responsiveness of the UK labour market. The third shock, and the most immediate of the three that I want to talk about today, is the increase in energy prices. Sterling oil prices are now more than double their levels in 2020 Q4, and wholesale gas prices have quadrupled. That's been driven by a combination of higher demand as the global economy has recovered, disruptions to supply, and geopolitical tensions, which are intensifying. Higher wholesale energy prices mean higher fuel bills for households and higher input costs for businesses. The increase in energy prices, together with the increase in global goods prices, is already pushing up significantly on UK consumer price inflation. The latest inflation outturn was 5.5%, significantly higher than our target rate of 2%, and the majority of that overshoot was accounted for by energy. And energy will push up further once Ofgem's utility price caps are reset in April, which is likely to see household utility prices rise by as much as 50%. And we expect inflation to rise higher still, therefore, and peak at around 7.25%. The rise in energy prices, together with the rise in goods prices that I've already mentioned, will put a very significant squeeze on real household disposable incomes, which we expect to fall by 2% in the coming months, the most significant squeeze on real income in 30 years. This is an extreme example of what economists call a terms of trade shock, an increase in import prices which raises the cost of living and reduces real national income. Assessing the impact of the energy price shock is probably the key judgment in the MPC's latest forecasts, which we published in the February Monetary Policy Report earlier this month. In a speech last July, I highlighted the challenge of forecasting the economy through the COVID shock, and the challenges and uncertainties associated with forecasting have intensified with the rise in energy prices. In our latest 3-year forecast, we assume that higher energy prices and the associated real income squeeze will persist. That in turn, along with tighter economic policy, weighs on consumer demand and output, such that GDP growth slows from a rate of 1.8% over the next year to averaging 1% in the second and third years of the forecast. Reflecting that slowing in demand growth, unemployment rises to 5% over the forecast period, and inflation, having fallen back to a little above our 2% target within 2 years, ends the forecast period actually below the target at 1.6%. Now, in the near and medium term, what matters for consumer prices and inflation is how monetary policy responds to the energy price shock. The MPC has already taken action. We voted to raise bank rate from 0.1 to 0.25% in December, and then again to 0.5% in February. We also agreed to end reinvesting maturities from our stock of UK government bond purchases, consistent with the guidance we gave back in August that we intended to do this once bank rate had reached 0.5%. Our balance sheet, as well as the government's balance sheet through policies like the furlough scheme, took some of the strain of the COVID and Brexit shocks through our QE programme. We purchased 440 billion of government bonds since the start of the pandemic, with the aim of lowering long-term interest rates. Now that monetary policy is tightening, the time has come to unwind some of our purchases. We've also given guidance that we would consider beginning the process of actively selling some of our government bond holdings only once bank rate reached at least 1%, though our guidance does not make an automatic link between the bank rate threshold and the decision to begin sales. Now, what I want to do now is to explain why we took these decisions to tighten policy and say a little about how I'm thinking about the outlook for monetary policy for bank rate in future. The first thing to say is that what monetary policy cannot do is prevent the rise in energy and tradable goods prices, or the hit to real incomes that will follow from them. Those are global shocks, and their drivers are real-world factors like supply chain bottlenecks, which an increase in interest rates would do nothing to resolve. What is more, the effects of changes in interest rates come through with a lag, meaning that even if we wanted to, we would not have been able to offset the immediate and direct impacts on inflation, what economists call the first-round effects. I also recognise these are tough times and that for some businesses, raising bank rate will increase interest payments and so potentially add to the challenges that are already being faced in the face of the energy price shock. But what monetary policy can do is ensure that as the economy adapts to this shock, it does so in a way that is consistent with meeting our inflation target of 2%, and that current increases in prices do not feed through to further rounds of price increases in the future, what we would call second-round effects. To make that happen, we need to ensure that households and businesses recognise that we could not tolerate persistent overshoots of our inflation target, and so do not factor expectations of persistently high inflation into their own wage and price setting. And if necessary, we need to take action to prevent that kind of persistence setting in. The tightness of the labour market is something I've already touched on a number of times in this speech. At the time of our February MPC meeting, unemployment had fallen to 4.1%, and we expected it to fall further in the near term to 3.8%. Private sector regular pay growth had slowed to 4.1%, though that headline figure is distorted by the effects of the furlough scheme and changes to the composition of the workforce. Bank staff estimated that once those effects were excluded, underlying pay growth had remained at around 4 to 4.5%, above pre-pandemic rates of around 3 to 3.5%. Perhaps most strikingly, a survey of firms conducted by the bank's agents suggested that the average pay settlement was expected to rise to almost 5% in 2022, with the pickup broadly based across different sectors of the economy and firms of different sizes. Alongside the tight labour market, measures of households and companies' short-term inflation expectations had risen further, as had pricing expectations of firms in the bank's decision-maker panel, a survey which covers nearly 3,000 firms across the economy, including a number in agri-food. Some firms in the agent's survey also report that they have started passing on their higher labour costs to their prices and will seek to do more so over the next year. And market-based measures of medium-term inflation expectations, which I continue to monitor very closely, remain well above their average levels. Against that backdrop, my view and the view of the Monetary Policy Committee was that a tightening in monetary policy through an increase in bank rate was warranted. And 5 members voted in February to increase bank rate by 0.25%, and 4 of us, including me, voted to increase it by 0.5%. Personally, I felt that a 0.5% increase in bank rate would have been warranted in February, in line with a watchful and responsive approach to monetary policy. I've been concerned about the emerging inflationary impetus from a tight labour market and from a broadening out in price pressures since last summer, as I set out in a speech in July. As I've seen those risks grow, and to ensure they don't become too embedded, I've been voting for some front-loaded tightening in monetary policy since last September. So while it was a finely balanced decision for me, I was persuaded that a full 0.5% increase in bank rate would have been appropriate at the February 2022 meeting. Looking ahead, like the rest of the committee, I judge that if the economy develops broadly in line with the February MPR forecast, some further modest tightening in monetary policy is likely to be appropriate in the coming months. The word modest is significant here, though. I do not envisage bank rate rising to anything like its pre-2007 level of 5% or above, let alone to the kind of levels we used to see before the MPC was formed in 1997. Of course, there are always uncertainties around any forecast, and new shocks can arise. We did not foresee the recent rises in energy prices, and as we meet today, the crisis in the Ukraine is intensifying. And so we should remain humble about the possibility that things might turn out differently. Two of our forecasting assumptions are particularly relevant here. The first is the convention of assuming wholesale energy prices will stay constant beyond the first 6 months of our forecast. As I set out earlier, the uncertainty around this assumption is very high at the moment, and it's quite possible that they could fall back significantly or even rise further. In the Monetary Policy Report, we published an alternative scenario in which wholesale energy prices do fall back along the path implied by market futures prices. In that scenario, real incomes are less squeezed than in our main forecast, GDP growth is stronger, and unemployment does not rise as much. But inflation is significantly weaker, ending the 3-year forecast period 3/4 of a percentage point below our 2% inflation target at 1.2%. The second important assumption is the path of bank rate itself. In our central forecast, bank rate is assumed in line with the usual convention to follow the path implied by financial market expectations of monetary policy, which in February, when we did the forecast, meant assuming bank rate peaked at 1.4% in mid-2023. Market rates have risen significantly more since we published that forecast and now have bank rate peaking at almost 2%. As a sensitivity analysis, in an alternative scenario in which bank rate followed the current market path, but keeping other assumptions, including the constant energy price assumptions, unchanged, inflation would fall below our 2% target within 2 years and end the forecast even lower at just 1.4%. Now, the additional uncertainty around these assumptions makes it particularly difficult to make predictions about where monetary policy might be headed in the medium term. In the near term, as I've set out, some further tightening seems likely to be needed to prevent current high inflation becoming embedded in wage and price setting, which would create further upside risk to inflation. But as the alternative energy scenario, which I've described, illustrates, there are also downside risks to inflation ahead. And as the alternative bank rate scenario I've described shows, there are also risks from tightening monetary policy too much. The energy price shock has created a particularly challenging trade-off for the MPC to manage between strong inflation and weakening growth. We will need to remain watchful and responsive to events as they unfold. In conclusion, these are challenging times for the UK economy and for UK households and businesses, including in farming. But the UK economy, like the farming industry, has so far proved resilient, notwithstanding the scarring effects of COVID and Brexit, and has weathered the shocks and returned to pre-COVID levels of output for the economy as a whole. A central question for the outlook is whether the UK economy can build on the resilience shown to date and continue to expand in the face of the ongoing effects from energy prices and other shocks in this age of uncertainty. How best the UK can take advantage of the opportunities in a post-pandemic net zero future and what the blueprint for that future should look like will depend on policies well beyond the remit of the Bank of England's MPC. But what the Bank of England MPC can do is ensure a stable foundation for future developments. We are currently experiencing a period of inflation which is higher than we've seen for many years, the biggest challenge on inflation since the bank gained operational independence of monetary policy in 1997. And that will have real consequences for UK households and businesses. But unlike earlier inflationary episodes, where we saw more persistence in inflation caused by ineffective policy and policy frameworks, this time we have a framework which empowers us to take action and to set monetary policy so as to achieve the 2% CPI inflation target sustainably in the medium term. Thank you.
I will now try and balance the online questions with the real questions in the room. And if I'll start with an online question to you, Dave, but if I could get Gary Yeomans and Ali Kappa to please go to a microphone. And I was intrigued looking at your hobbies, walking, cycling and rock climbing. Does this translate into mountains as well?
Yes, it does.
Serious rock climbing.
Yes. When I'm not doing or making decisions on monetary policy, I spend a lot of time doing all three of those things right around the UK. So, yeah, it's a way of decompressing, but it's also a different kind of challenge.
Perhaps it's something I should take up. Might help with the current situation. I've got a question online here, which basically will be very in tune with everybody in this room, which says, given the dominant impact of energy prices and global bottlenecks on tradable goods, and the fact that it's driving this inflation, basically, i.e. in the supply side issues, not in demand, how effective is increasing interest rates in tackling inflation? You portrayed, and you've taken quite a hawkish approach here. It's a bit of a tightrope, though, isn't it, to walk?
It is. I mean, it's a very challenging situation where you've got this shock, or shocks, as I've described, coming from both global energy prices and global goods prices, because we are importers as a country of those products. That, you know, there's nothing we can do to increase production to offset it. That shock will hit our national income, and the inflation that goes with it is also, it's a global phenomenon, as you say. However, what we have seen is two things, really. We've seen a very tight labour market now for, including throughout most of the pandemic, but tightening particularly recently, with vacancies at record highs, unemployment close to its historic lows at 4%, wages picking up. And at the same time, we've also seen pricing behaviour change with firms. We're beginning to see prices rise, not just necessarily in response to those imported costs and input costs, but you're also seeing wider increase in prices right across the economy, including services. And I think the Monetary Policy Committee can do something in response to that broadening in price pressure by putting up bank rate. And, you know, it is worth stressing, bank rate is still only at 0.5%, but it is rising, and financial markets expect it to continue to rise somewhat, and that's also what our thinking is if the economic outlook is in line with our forecast. So by putting up bank rate, we can put some downward pressure on demand by increasing the cost of borrowing and increasing the benefits from saving, but equally by showing our commitment through tightening monetary policy, through putting up bank rate, we're trying to send a signal that we can't tolerate a generalised rise in inflation for long that exceeds our 2% target. And in that way, we can guard against a broader inflationary mentality developing in the economy. We can bear down on inflation expectations. And over time, as shown on our forecast, within 2 years, inflation is back to close to the 2% target and actually falls below the 2% target after 3 years. So there is something we can do. It is a balancing act, as you say. And what I've set out is that we see the case, if that economic outlook transpires as I've described, for modest increases in bank rate. But as I tried to emphasise, we don't see bank rate going back to anything like the levels that even we experienced back before the global financial crisis, when bank rate was up at 5%.
And of course, we can't really, I'd love to get onto the political side of things, which I won't, but you are working with the perfect storm of political environment on these massive inflationary costs on labour, which is very hard for you at the Bank of England really to predict as to what that is going to do. But I must open it up, and if we could go to Gary Yeomans first and then Ali Kappa, please. Gary.
You're obviously very well aware of our rising costs and budget. Energy. When the boss of Tesco says that the shopping basket is going to rise by around 5%, who's going to make up the shortfall?
Thanks for the question. Just to re-emphasise what I stressed, although we set policy for the economy at the whole, if you like, for the whole of GDP and inflation across the economy, we are acutely conscious of the pressures in different sectors, and particularly, as you emphasise, and as actually Minette emphasised in her speech, I think the ONS numbers for the aggregate index of agricultural product input costs is up 18.6, and I think output costs are lagging that at something like 11.6% over that same period. What you've then drawn attention to is what are the potential increases in consumer prices. And I think from our perspective, we understand the challenge that poses for you as an industry, the squeeze that that puts on your position, your margins that you were referring to, Minette. What we have to think about, though, for the economy as a whole, bearing in mind the challenges that you as a sector are facing, is how do we over time help support the economy to adjust so that we don't get back into that position where we have high generalised inflation. Obviously at different times, different sectors, particularly at the moment, will be experiencing very divergent rates of inflation, very particular challenges, particularly the farming industry. We on the MPC have to think about the economy of the UK as a whole, inflation for the whole economy, and focusing on getting inflation back to that 2% target, trying to do what we can to support the adjustment, but recognising the adjustment is very painful, and particularly, as you've highlighted, with some fertiliser prices going up 200%, some energy prices going up more than that. It is an incredibly challenging time, but all I can, I guess, really emphasise is that we recognise just how challenging it is. But in the area we are directly responsible for, given our remit for monetary and financial stability, we have to focus on that, mindful of those wider challenges.
So Dave, thank you. Ali Kappa, please.
Good morning. So David, Ali Kappa, Chair of the Horticulture and Potatoes Board of the NFU. My question is also about inflation. I'm not sure whether it's just me, but I certainly feel that inflation is going to go higher for longer. I don't know whether I'm alone in the room in feeling that. As a sector, we have energy and fertiliser costs that are rising in triple digits for all of us. I don't know anybody that isn't in triple digit inflation. Labour, haulage, packaging and fuel rising in double digits. And actually government policy at the moment making some of that worse, not better. In my sector in particular, we were given a Labour inflationary piece that looks like it could be nearly 40% this year. So my question is, where do you believe food inflation will be by the end of this year? Because it feels like it's got to go up, and that's very uncomfortable for all of us.
Before you answer, I'm just going to get Bridget Christensen to go to the microphone. David. Do you pick up Ali's question and Bridget will have...
I'm noting rapidly. Oh, you want me to answer it? Sorry. I was thinking it's one of those ones where I was going to take to...
My fault.
No, it's great to be in person, but it's different from being online.
You went on to mute.
I'll tell you, I said at the outset of my speech that my mum would be very pleased to think of you all gathering here. Actually, what she really liked was a kind of get-together. So she would really like to have been here herself. So on the question, I mean, look, first of all, I thought your emphasis on the persistence of inflation is absolutely critical. That's if you like the risk that we are most guarding against by tightening policy in the way that we are. Because we do want to avoid a situation where inflationary expectations, where more of an inflationary mentality becomes embedded right across the economy in firms' price-setting behaviour, in the inflation that households experience, in the inflation also that you experience, because we've seen the damage that persistent, high and volatile inflation can do to the economy. For example, in the 70s and 80s, it makes it very difficult to plan ahead, to invest for the future. All of that said, of course, as I try to emphasise in my speech, and as you've re-emphasised, the shocks that are coming in terms of fertiliser prices, other input prices, are very, very significant. And it means that in terms of some of the goods that you have to buy for your production, fertilizers, etc., you're experiencing much higher inflation rates than the rates I'm seeing as a monetary policy member for the economy as a whole, monetary policy committee member. When we look at aggregate inflation, we forecast it will peak at 7.25% in April. Then we think it will come down over the next year to about 5.25% at the beginning of next year. So there is already some persistence there, which is a concern. But then as these, what we still see as transitory effects from these input prices ease, and also because of the effect of our monetary policy starts to impact, we think by the second year of our forecast, by the beginning of 2024, inflation will be close to target of 2% and actually below target at the end of the forecast period. So that's the macro picture that we foresee with lots of uncertainties around it, but that would be one where we get back to low and stable inflation, which is, we think, the best contribution we can make. As to your specific question, we don't do a detailed forecast, we don't do a bottom-up forecast for each sector, but within that aggregate figure of 5.3% or so for inflation in a year's time, obviously that will embody inflation in food prices and other things, but I'm afraid I can't, other people like the chair of Tesco's can give a forecast for food price inflation. We focus on the aggregate inflation. However, I guess my final point would be to recognise just what a challenge it is. I mean, Minette in her speech and me in my speech, with a slightly different focus, but both emphasised, just what an extraordinarily challenging period it is at the moment. I mean, I sometimes think it's quite challenging for me, but I recognise the challenges I face pale into insignificance as a monetary policy maker compared to what you're all dealing with in your daily lives.
On that point, in your lifetime, 10 years as a chief economist at the Treasury, have you ever seen anything quite as extraordinary, bearing in mind the point that Ali made around potentially growers facing 40% inflation on labour issues? I mean, it is a perfect storm.
I think on inflation, I haven't seen as challenging a set of circumstances as this. You know, I became Chief Economic Advisor to the Treasury working for Alistair Darling in 2007. On the eve of the global financial crisis. I always stress that was a coincidence with me getting that job. However, so that was an incredibly challenging time because, you know, we were literally, as Alistair says in his book, Back from the Brink, we were dealing with the potential for the whole financial sector, which we rely on, you know, to borrow money from, you know, certainly people in this room do. You know, I might for a mortgage. That whole, you know, that was a really scary and challenging time, but it was a different kind of challenge than we face at the moment with these three shocks that I was emphasising interacting. You know, first of all, the shock of the decision to leave the EU, then the pandemic 2 years ago, now the energy price shock, and with the intensification of the crisis in Ukraine, you know, creating uncertainty about where we go next. I think, you know, in terms of uncertainties, this really does feel like a kind of the age of uncertainty, which is, I know, a real theme for your, you know, is that the new normal that we've all got to kind of work with and find a way through? And I think for us, we think the best thing we can do is stick to our mission to deliver that financial stability that I've talked about. Unlike in the global financial crisis, banks are really part of the solution this time round. They are still lending money. I realise that might not always feel like that to all of you if you're renegotiating a loan or something, but you know, they really have been able to continue to advance lending, and that we on the Monetary Policy Committee can focus on trying to get inflation back to that low and stable level of around our 2% target.
To that point. We have Bridget Christensen and Paul Brown. Could you make your way to the microphone? Bridget.
Good morning, Sir David. Moving away from the inflationary topic, I represent farmers for the NFU in the Mid-Somerset branch. In farming, the predominant business model is family farm partnerships, not limited companies. How does the Bank of England accommodate or adapt its fiscal and monetary policies to take this into account?
Okay, that's a pretty specific question, but very much recognising how that, you know, how that particular business model works. I mean, from our perspective, as I've said, we're incredibly privileged at the Bank of England that we have this nationwide network of agents who do talk to businesses big and small, those in limited companies, those in the kind of partnership model that you've talked about. We also talk to the kind of, you know, the trade bodies like the NFU, also, you know, Small Business Federation. We try and get as much granular information as we can about what's going on the ground. And that's been particularly relevant actually since the Brexit shock. In the past, we might have more relied on the nationwide, you know, UK level statistics and intelligence. But what we've seen with the Brexit shock and then with the pandemic again is just what a differential impact it has on different sectors of the economy at different times. And you know, we saw that from the film at the beginning of the conference. You know, when I was watching Clarkson's Farm, you know, his surprise, I mean, he gets surprised quite a lot through that series, but his surprise that he's been judged to be a key worker. But that's absolutely right, because early on in the pandemic, we had those concerns about just the supply of food, weren't so worried then about inflation, but very worried about would actually, the food be got out of the ground, particularly after the floods the previous autumn. Would we have, given the supply chains that would bring all the imported food that we rely on were being disrupted by the pandemic, where would our security of supply come from? And I guess for me, that's an example, and sorry, it's a bit tangential to your point, but why I would say that since Brexit, but particularly with the pandemic, we at the Bank of England are much more mindful and much more alive to what's happening in different sectors of the economy, but also then within sectors. I mean, thinking how diverse the business models are. You've got hill farms like the one my mum was born on, where you'll have a summer farm in the valley, and then you'll have the winter farm in the valley. I'll get that the right way round. The winter farm in the valley, the summer farm up on the hill. You've got much more the kind of arable farms, the sort of thing that Clarkson's farm is more based around. And I think just for us, seeing how these shocks like Brexit have played out, but then particularly how the pandemic has played out, has made us much more alive to differential effects at different times. Whether we can really sort of distinguish in our information between a limited company and a partnership, that's probably a different issue, more for the business ministry. But we are very conscious of the impact these shocks are having and what they're doing to your economic performance.
Paul Brown.
Thank you. Sir David, Paul Brown, Vice Chairman, Staffordshire NFU. As basic payment scheme is phased out, alternatives coming through such as landscape recovery and farming transformation fund may only be available to a limited number of farmers. Therefore, would you support the introduction of a scheme similar to the bounce back loan so that affordable finance is available to a larger number of farmers, especially the average family farm, so that we can invest and modernise for the future?
It's a really good question, and it goes to the heart of the transformation that I touched on, and Minette was talking about much more in her speech. I have to say, I'm probably only an O-level student, not even an A-level student, when it comes to what the new package of measures under the environmental land management scheme are going to look like. I did a bit of homework about the different components that I understand DEFRA is introducing, and I saw from something on the NFU website that that there is this concern around whether for many of the smaller farms, which do make up quite a lot of our farming industry, back to that diversity point of business models, whether there will be enough support. All I can really say is that from my perspective, I now recognise the issue, having done, as I say, a bit of homework, and I hope I'll learn more about it, when I return for the dinner this evening. And really, I think that's probably best a question to direct at the Secretary of State later.
I think our biggest worry is that he's probably still at O-level capability of understanding it too. We are indeed getting slightly short on time. I'd like to have Kathy Case up as I think our last question, if I can. And you've witnessed some extraordinary times in your career. You were very much involved in the decision of whether we should join the euro or not. Where we are right now, where we've left the settled state way of working, we've got an extraordinary global situation, but we've got a very politically intense one here, where effectively our government has promised the nation cheaper goods, cheaper food, cheaper clothes, cheaper shoes you will have. And now we see this exponential rise in the cost of living. And, for that time that you had in Treasury, if you were sort of redefining the new world effectively as to how we manage our risk, when I was out in Washington and looking at their equivalent of Treasury, I see environment is part of Treasury over there. are there ways of learning? You know, we've got the American Farm Bill, which actually is probably more protectionist in many ways than anything that the EU has had. You know, massive investment in agriculture, ways of managing risk, ways of intervening in the market. I just wonder if you have any thoughts on what good would look like, or where they politically maybe could be aiming for in Treasury right now.
I mean, I've been out of the Treasury for just over 4 years, and the thing about being in the Treasury was that, you know, you have this, you work on this mantra that officials advise and ministers decide. So as a Treasury official, I would never have done something like this. Now that I'm actually responsible for making decisions, such as on bank rate, it means I have to be accountable, and which is why it's fantastic to be here today. Be great to be coming back later. In between, I'll be talking to others to try and explain what we can do. I guess what I can say is that I'm very much picking up from your speech, from the website, from what I hear from your members, the strength of feeling, the challenges you're facing, and so we can certainly feed those, you know, back to colleagues. No doubt the Minister will be hearing more of the same, if not even more intensely later. I mean, one point I would make, because my background is as a, you know, bit like one or two of the people here, as I'm an economist. One thing I really learned from my time at the Treasury, as I say, starting as chief economist in 2007, before, you know, the biggest financial crisis for 100 years or so, you know, going back to the great crash of the 1920s. Now we're dealing with a once in 100-year pandemic. One thing I think it's really important that policy can do, and I try to put this emphasis on my approach to the policies we're responsible for, to be watchful but also responsive, is I think we have to be really alive to those possible different futures. You can't just have one forecast. You have to think we could be in a completely different place with it, which needs a completely different scenario, and we have to plan for that. That's why I emphasize those scenarios at the end of my speech. A different possible future for energy prices, which would be more benign, or a different possible future if we had a different path for bank rate. And I think preparing for the unexpected, managing that uncertainty, would be something that I think is relevant to all policy. I'm sure that's what everyone in the room does when they're planning, you know, what are they going to grow over the next year? What are they going to produce? You know, you work within some tolerances, and then, you know, you get huge floods, or you get the storms of last week, you get hit by stuff, and you have to adapt. So a policy can't adapt to every eventuality, but you can try and build the resilience within the policy that will then support the resilience of the, you know, whether it's the farming community or whether it's the wider economy. And so that would be my main learning. I know that doesn't specifically answer your questions, but I think it's still relevant to them.
I completely agree. Cathy Case, please.
Thank you. So farming in Devon, be very interested to hear your theories on levelling up. It's certainly high on the government's agenda, and this should have a real impact for rural areas, which are often seen as those tranquil locations between economic centres. What steps should farm businesses take to take advantage of the levelling up agenda? And will local regional economic partnerships have a role to play?
Thank you, Cathy.
Yeah, that's another great and important theme. You know, when you think about the challenge that we're dealing with, and that you had a big focus in your speech on, Minette, with climate change and how we get to net zero, levelling up, you know, as described by the, you know, that's the framing used by the current government. But it's also been an objective of previous governments, and one that, you know, I worked on a lot at the Treasury. I mean, I think what's most interesting about, or there are many interesting aspects of the current levelling up white paper, which actually the former chief economist of the Bank of England, Andy Haldane, went off to work on, it is that emphasis that you put in your question on how can you make a contribution at the kind of community level, the local level, and then the national level. I mean, the way I think of it, and this also comes through not just in the Levelling Up white paper, but a charity that I'm a trustee of called Pro Bono Economics. We've contributed to this, some thinking, is that you've got three sectors in the economy. You've got the private sector, you've got the public sector, which is, the government, it's us in the Bank of England, and then you've got civil society. It's often called the third sector as if it's the last sector, but actually that sense of community, that sense of being willing to volunteer, not necessarily for a return, but to make a contribution, something that we saw a motive coming through very strongly in the pandemic. I think anything, the Levelling Up agenda is obviously focused on things like, raising national income, making sure that it's more evenly, that we see national income in more, high levels of national income in more regions of the UK, more communities of the UK than currently. So that's an age-old ambition. If we could raise the productivity of the lowest productivity regions up to the highest productivity regions, such as London, where I live and work, it would make a huge difference. But equally, you want to balance that productivity also with well-being and environmental sustainability. And I think that's where the three sectors working together in partnership, can be incredibly valuable to achieving levelling up in the broadest sense, beyond just the economy, to sort of improve societal resilience and also environmental resilience. So I put emphasis, this is getting a bit, we don't target well-being in the Bank of England, I should stress, we focus on inflation, but thinking about the widest group, not just of policies, but behaviours, including, as I say, from the third sector, and partnering, the private, public and third sectors to get that kind of increased resilience that we saw through the pandemic. How do we sustain that? I think that would be, that for me is some of the most interesting stuff as, again, a student of government policy that I see in the Levelling Up white paper. The challenge will be whether it gets delivered, which is always the challenge of policy. That's also the challenge, that you're dealing with for the policies that impact on you, such as Levelling Up, but also the direct ones that you were talking about in your speech.
Absolutely. I think the most important thing that it is joined up, and at the moment it doesn't feel joined up. The plan needs to be joined up across all departments effectively, and the ambition as well. I'm conscious that we're getting short of time and I'm intervening. Luckily, I can't see our Director General behind me, but I'm sure he's agitating to get on with the next session. Conference, please, I think it's been a very candid insight into the workings of the Bank of England, and I think we've inspired you to have even wider engagement than you do already with the agricultural sector. So, Conference, please, can we show our appreciation to Sir David Ramsden?